Welcome back to Riding Academia. We are still on our series on the adjustment to the financial statement, okay? Now, today we are going to be looking at depreciation, okay? We're going to be seeing how we can treat or deal with the depreciation when we have depreciation. That is, in this case, I'm talking about just the trial balance, not the treatment from the scratch, okay? I'm talking about how we treat it when it is in the trial balance, how we treat depreciation when it is in the additional information, okay? Yes, that's how we adjust for depreciation. That's what we want to be talking about today. Now, in our previous video, we looked at accrued income and accrued expenses. We've looked at prepaid income and prepaid expenses, okay? So this is depreciation, and then like I said, we are looking at how we treat depreciation when you have it in the trial balance and then when you have it out of the trial balance. All right, now in the trial balance you can never have depreciation for the year. Okay, yes, that's one thing you must note, that you can never have depreciation for the year. That is the current year depreciation in the trial balance. You will always have to adjust for it at the end of the year, at the end of the period, so you can deduct it from the comprehensive income to get your net profit. So depreciation for the year is always outside, that is in the adjustment. They will give you the information that will help you, that will guide you on how to adjust or calculate depreciation for the year. Now, yes, you also have another type of depreciation in your trial balance. That type is either you see it as provision for depreciation or accumulated depreciation, any of those two words, okay, which also the same treatment, okay. Provision for depreciation or accumulated depreciation. Now, we're talking about maybe depreciation from the previous years. Now, it is worthy to note that since depreciation is not an actual expenses, like it does not really involve cash going out, we're not paying anybody, money is not really leaving the business, money is just leaving a specific account to another account, a separate account, okay. So since it is not really an actual expenses, the money does not go out, so it is retained in a particular account, okay, and that's where we now start having the term accumulated depreciation. So the depreciation for the first year is kept in that account, the second year is also kept in that same account. So what you have in the account is cumulative, that is from all the previous year depreciation onto the current moment. Are we together now? So when we now adjust depreciation for the current year, when we get to the statement of financial position, we will now reflect it and add it, the current year's depreciation, to the accumulated depreciation in the trial balance, okay. Now, so what I'm trying to say is this: let's assume you have a trial balance. Mostly what you see, like I said, is accumulated or provision for depreciation. So you have accumulated depreciation, okay. Now you will never see your accumulated depreciation on the debit side. Remember your trial balance format. This is the debit, this is the credit, okay. I'm just trying to use a picture illustration. You will never see accumulated depreciation, the figure in the debit side, okay, because that's more like a reserve. I want to use that word. It's more like a reserve. Money is set aside, okay, for the profit of the business for a particular purpose. So you will never see that amount in the debit side, on the debit side, because it is not an actual expenditure. You will see that accumulated depreciation on your credit side, showing that this money has been deducted in the previous year. Now it is an income. Yes, it is an income, or let me say, in a way, it's more of revenue that is kept for a particular another purpose. So it will be on the credit side, it will be reflecting on the credit side until the particular time that maybe we use the money to buy another asset, okay. Then we can now write it off, have to debit, and then bring the money back to the asset side. All right, now, like I said, we want to see how to treat depreciation. There are lots of things that have to do when we talk about depreciation. Yes, it's going to be a very long series, okay, so I'll try to see how we can move little by little. We have an illustration that we are going to be attending to. All right, we are going to be attending to, then we'll see how we deal with depreciation in the trial balance and of course in the adjustments.
So we have an illustration before us that an information has been extracted from the trial balance of XYZ Limited for as at 31st December 2020. So you can see the trial balance. You have your debit and credit side. You have your particulars, your assets, your non-current asset here, land and building, and then we have equipment, and then we have furniture. Okay, now you have purchases and sales. The amount is given, carriage inwards is an expense, so you know where it's supposed to be, right? We have returns, inward and outward, you know where they're supposed to be. Inventory is here, that's opening inventory. Wages and salaries is here. Stationaries, we have utility, we have general expenses, discount, commission, Payables, receivables, okay. Capital, we have cash, we have carriage outward. We have bank on the credit side, okay. That means this is an overdraft. And then we have accumulated depreciation, which is our focus for today. We have for equipment, we have 50,000 naira. For furnitures, we have 30,000 naira. And then drawing is given. Then we have a balance account of 4,900,000. Now, our additional information, we have that stock as at 31st of December 2020 is given to be 75,000 naira. Depreciation on equipment is to be 25% of cost, okay? Why 10% is to be charged on the balance of furniture. So these are two different ways by which we calculate annual depreciation. Either you calculate on cost or you calculate on the reducing balance, okay? So we're going to be also looking at this today. Now we are required to prepare the statement of comprehensive income and then the statement of financial position as at 31st December 2020. So with this, we can move in and then we'll solve together.
So what we are going to do is that we are going to quickly solve this question, okay? Now, like we have read together that this information was extracted from the trial balance of XYZ Limited. So the first thing we always do, like we always do in any in preparation when we are preparing any account, is that we always indicate the name of the company or the name of the business, okay? So in this case, this is XYZ Limited. So this is the name of the business, okay? Now we have all the information given. What we're going to do is that I'm going to, since it's going to be a very long video anyway, so I'm going to rush through, okay? Then when we arrive at gross profit, then we'll bring the video back and then we'll continue from there, okay? So we have arrived at our gross profit, right? So this is the direct aspect of our comprehensive income. Just compare direct income and direct expenses, okay? So we know how to do this, okay? Your sales, you are less in returns inward, then you arrive at your net sales. Now we have opening inventory. We're going to adjust for cost of goods sold. So we have purchases carried inwards, returns outward to arrive at our net purchases. That's 880,000, which you are going to add to opening inventory, right? To give you cost of goods available for sale. Then you less closing inventory to give you cost of goods sold. And then we less cost of goods sold from direct income, that's net sales, okay, to give you your gross profit. Now we are through with the direct aspect. So the next one we're going to do is that we'll add other incomes and then we'll deduct other expenses, all right? So the other incomes we have here as given in the question, we have discount received, okay? Incomes will always be on the credit side, like I said. So discount received is here, and then we have commission on the credit side, even though it was not stated whether it was received or paid, okay, but it was on the it was entered or recorded on the credit side, okay? So that means it was commission received. That discount received um amounting to 50,000, and then we have commission received amounting to 350,000. So our total other incomes was 400,000. When we add this, our total income for the year, we're going to have 1 million. Okay, this is our total income for the year. Okay, 1,205,000. So the next thing I'm going to do, we're going to adjust for other expenses, other expenditures. Okay, so we are going to adjust quickly. So for other expenditures, I'm just going to read through the list because in this case, this particular video is just on depreciation. So there was really no adjustment like we did for accrued income or accrued expenses and then prepaid income or prepaid expenses. So there's no adjustment as pertaining to those four. Okay. So what I'll just do is that I'll just run through it so that we'll arrive at where we need to treat depreciation. Then I'll be able to explain better. These are all the expenditures, okay? We have wages and salaries, we have stationaries, utilities, general expenses, discount allowed, and carriage outward, okay? So now the next thing I want us to understand, which is the aim for this video, is how we are going to be able to treat or calculate depreciation. Now from the onset, I told us that the depreciation that you see in the trial balance, what you see in the trial balance, that depreciation in the trial balance, that's accumulated depreciation or provision for depreciation, it still means the same thing, okay? That depreciation in the trial balance, what I'm trying to say is depreciation in the trial balance is not this year's depreciation, it is not the current year depreciation. So from previous years they have been charging depreciation, so they will keep adding the money in a particular account, okay? For the first year you charge depreciation, the money is in a particular account. Let's say you have 50,000 as depreciation, as your depreciation for the first year, you keep it in a separate account. The next year you have 20,000, keep it in that account. So now your cumulative is 70. but it does not include the current year's depreciation. So what we do is that we bring forward, okay, balance brought forward. We bring forward the cumulative from the last year in the trial balance. Then we calculate this year's depreciation at the end of the year, and then we add this year's depreciation to the cumulative before to give us cumulative for this year. Okay, so cumulative for this year has to be last year's cumulative plus this year's depreciation. Are we together? And what we reflect in our comprehensive income statement is always just this year's depreciation, not the cumulative. What reflects here is just this year's depreciation. Then when you get to your balance sheet for the year, that's financial position for the year, you now reflect cumulative depreciation. Okay, that is for the year, last year's depreciation plus this year's depreciation in the that we've calculated. Okay, you add it together to reflect in your statement of financial position. So comprehensive income, like I said, just record expenses for the year. Okay, so we're going to only charge depreciation for the year. Okay, now there are two things to note. Number one is that we are told that the depreciation on equipment is 25% on cost, okay, of cost. So it means, how do we calculate this depreciation? You will just, this is the simpler one, you will just charge 25% of the cost as depreciation. Okay, so we are told that the cost of equipment from the trial balance is 200,000. Now depreciation of equipment is supposed to be 25% of cost. So this is what we are going to do. Depreciation, so for your equipment, you have 25% of cost, okay? 25%, and your cost, like I said, is what? Your cost is 200,000. So you're going to be having 25% of 200,000, okay, as your depreciation for the year. Are we together? So 25% of this will give you what? We're going to have 50,000. Okay, so we are suspending zero, so I'm bringing just 50. So we have gotten 25% of that. Now the second thing is this. Now we are told that with respect to furniture, our depreciation is supposed to be 10%, not on cost, but on the balance. Okay, this is now another method. So when we have depreciation to be charged on cost, just take the figure, multiply by the cost of the assets, and we are good to go. But now this is to be charged on the balance of the furniture, means that what we do is that first of all, you have to, the balance means you have to remove last year's accumulated depreciation from the cost of the furniture to get a balance. Then you charge this depreciation on that balance you've gotten. Not, okay, that's what I'm going to do, not on the cost directly, but that you adjust it, you remove that last year's accumulated depreciation, and then you arrive at a balance. So it is that balance that we're going to charge this year's depreciation on. Are we together? So this is how it's going to be for the case of furniture. Okay, so it is to be 10% on the balance, right? So how do we get the balance? The cost of furniture is 100,000. The accumulated depreciation from last year as reflected in the trial balance for furniture is 30,000. So to get the balance, we're going to have this. To get the balance, we're going to have 100. Okay, allow me to, please permit me to suspend zero. 100 minus 30. Okay, that's the figure. The cost minus accumulated depreciation, then multiplied by 10%. Okay, so like I said, it's on the balance. Are we together? Multiplied by 10%. This is it. So 100,000 minus 30,000, okay, then that you get a balance of 70,000. It is that balance you're going to charge this depreciation. That's the two ways we calculate annual depreciation. Either they ask you to calculate directly on cost, which is the easier one, or on the balance, so you have to adjust. You remove the accumulated depreciation for last year, and then you now calculate your depreciation on that balance that you have. Okay, so with this you're going to be having 70,000, and then you charge 10% of 70,000 to give you what? 7,000. So this is it. So this is how you do it. That, and mind you, I said this is for the year, right? So when we come to your statement of financial position, you will have to add for the year to the accumulated depreciation that was given in the trial balance to have the total cumulative depreciation for the year, that is up to this level, up to this year end. Are we together? So this, we've gotten all the expenditures we have. We're going to total our expenses quickly, then we'll arrive at net profit, which we are going to use in our statement of financial position. So we've gotten our total expenses after summing up all this, okay, to be 237,000. Okay, and then like we always do, which is our custom, we're going to deduct our total expenses from our total income, right? This is the third column. Total income is here. Okay, we're going to deduct our total expenses from total income, okay, to arrive at our net profit figure. And our net profit figure is going to be 968,000. All right, we have 968,000 as our net profit figure. All right, now in our second video we are going to be doing a part two of this so that it will not be too long. The part two of this is how we are going to show you, is where we are going to show you how your depreciation will appear in your statement of financial position. Okay, so like I said, this video, the aim of this particular video is just to explain depreciation and then how we treat it. So don't forget how you treat depreciation when they tell you to charge it on cost and then on the balance. Okay, so there are two different things like I've done here. Don't forget to like this video if it was helpful to you. Okay, subscribe to this channel if you haven't. You can click on the notification button so that when new videos drop you'll be notified immediately, and then you can share this video with as many as you can. So you watch out for part two, and then we'll see you in our next class. Thank you.